you up at night. Ask us about your favorite stock. 1-800-304-FNET. Give us a call. And Roger, thanks very much for joining us today. You know, we just heard comments by Abby Cohen. She says that she does not believe the market is overvalued. What's your view?
Well, I think if you look at the broad market, and the truly broad market, not the S&P 500, but the truly broad market, it isn't overvalued. We're able to put together a portfolio of 75 companies that have a 13.5 price-earnings ratio, a dividend yield of almost 3.5%, low price-to-book ratios, and a 10% growth rate. So on that kind of a profile, it certainly is not overvalued, but there are segments of the market that in fact are overvalued, and I would suggest that to the contrary, I think the S&P is representative of an overvalued capitalization-weighted index.
Well, I'm not going to quarrel. You certainly can get a bunch of low PE stocks put together in a portfolio, Roger. But what kind of return on equity are you seeing? What kind of returns do you get in this sort of market on those stocks?
Well, I think looking forward, we're going to have the rational expectations are going to be likely in the 10 to 12% area, and that compares to perhaps an 8% in fixed income. 6.75% today in U.S. Treasuries. So I think with that kind of a rational market, a 10 to 12% return is where it should be, and it certainly won't be a replication of the 20% that we've seen for the last 5 years now.
Roger, we were talking just before we started the show about the NASDAQ and what's been happening, and we're seeing some pressure today, and we've seen a little bit of weird action in the NASDAQ. How do you assess the trading pattern in the NASDAQ composite?
Well, it's basically reflecting, I believe, people taking, and when I say people, individual investors, institutional investors for that matter, taking money off of the table from very high-priced stocks that have given spectacular returns. The companies are still good, it's just that the returns and the prices are so high that the value's not there.
All right, we're going to continue our conversations with Roger, and he'll be back to take your stock calls as well after the break.
Let's give the number, 1-800-304-FNET. Give us a call. Back, and we're talking about stocks with Roger Debard. He's a portfolio manager at Hotchkiss & Wiley.
And he's taking your calls, so give us a ring at 1-800-304-FNET. We begin with our first call. Sandy from New York is on the line. Go ahead, Sandy.
Yes, good afternoon. I'd like to know your opinion on Wells Fargo Corp.
Well, Wells Fargo is an excellent bank. It's a broad-based holding company that in today's market with financial stocks appreciating and their cost-cutting and reorganization, it's today I would say probably one of the strongest banks in the country. Unlikely will be a bank that will be acquired, but they would likely be an acquirer.
Well, when you're buying banks in this this market now, are you looking to buy banks that might possibly be acquisition candidates, or are you looking at banks with a nice, solid, clean spreadsheet there?
The preference would be to be an acquisition candidate. At the same time, you're looking at the ability to be efficient and cost cut, so that you can see the consolidation of equals will be perhaps as interesting as owning a bank that would be acquired.
Are you worried about the dilution of earnings in like a Wells Fargo? Should it be an acquirer? Is that what would concern you?
That's the concern. So in other words, on an interim basis, maybe a year or so it takes for the acquisition to become accretive.
Okay. Let's go to Steve in New York. Go ahead, Steve.
Good afternoon. Thank you for taking my call. I'd like to preface this that I'm not a trader. I invest with the 3 to 5 or 7 year time horizon. Back in March, I took very large positions in several oil service companies, including Global Marine. Could you give me a 3 to 5 year outlook? I'll hang up and listen to the answer. Thank you very much.
Thank you, Steve. Global Marine is in I think, a strong position as a driller. They've got technology. They've got oil prices now at $27.50. That's a considerable difference from the 11 to 13 just a year ago. So I would say looking forward the next 3 to 5 years, so long as OPEC remains relatively well behaved and that oil prices stay in the 23 to 28 $100 range, global marine should be a very viable investment holding.
Roger, sitting at this anchor desk, we spent a lot of time speculating about oil and getting everyone's opinion. It has been quite a topic of discussion, especially with March coming up and the OPEC end of production quotas as a deadline is presumably March, although they have said that they would like to extend past that point. What's your assessment of oil prices? Where do you think they'll trade for a while?
Well, I think the most compelling reason that oil prices are going to stay relatively high is you've got an expansion of the global economies. You no longer have the problem in Asia, the developing countries of South America. So that's going to be the engine. You have virtually every part of the country is going to be increasing their demand for oil.
Would you be concerned if you're in the drillers, if the price of oil, you mentioned $23 a share. Is that sort of your price point for maybe looking and evaluating and selling out of those stocks, or would you go ahead and hold them no matter what?
No, I think particularly with the drillers, you need that price to create the incentive to increase the supply of oil. That said, when we were talking about OPEC, it's clearly oil pricing is clearly an administered price, so you are dependent upon the political whims of OPEC and the economic requirements of OPEC.
Taking a quick look at our oil stocks, are all lower today. Let's move on to Manitoba, exotic Manitoba, and Richard joins us. Go ahead, Richard.
Yes, good afternoon. The NASDAQ 100 QQQ on the listing, I was wondering when would be a good time to get in on some of those shares right now. They seem to be going down. They took a tremendous upslide. Is there going to be a particular point where it's a good time to buy in?
Well, it's a representation of what's going on in the NASDAQ market. It was up 85% last year, so you're looking at a very highly valued set of companies. I suspect that what's been going on for the last few days, where there's been a downgrading of many of the NASDAQ companies, and these shares are reflecting that it's going to take time to bring those prices down to fair value. So I think you'd have a considerable amount of time. Now, that said, it probably would make some sense to dollar cost average, because as a long-term investor, you're looking at companies that are likely going to be at the vanguard, the technology vanguard of this country. So I don't think there's any hurry, but I also wouldn't say today is the day I would be putting all of my money into that particular segment of the market.
That's a nice compromise decision, dollar cost average.
There you go.
Okay, we have to take a quick break, and we'll be back. We're talking with Roger Debard.
All right, welcome back. Time now for more of your stock questions. Our guest is Roger Debard from Hotchkiss & Wiley.
Give us a call, 1-800-304-FNET. Let's go to Washington and talk to Verl. Go ahead, please.
Hi, I love your show. I watch it every day.
Thanks.
I have quite a few tech and internet stocks, and I wonder if Oracle would be a good stock to add to my portfolio.
Well, it's an excellent stock, and again, we're talking about the price you pay, but Oracle is interesting. They'll earn about $1.14 per share expected in the year 2000, and perhaps as much as about $1.40 projected for year 2001. So you've got a company here that's got an excellent management structure and a growing earnings trend. It's just a matter of, again, what price you pay. I'd repeat that admonition of dollar cost averaging the acquisition of that kind of a company.
You're a very value-oriented kind of investor, but when you're getting into technology stocks, don't you have to adjust your parameters a little bit in terms of your notions of valuation? Because it's very hard and very tough. Oracle, generally very well regarded on the street, but it trades at a very pricey multiple, like a lot of these tech stocks do.
Well, the main adjustment that you have to make is a recognition that they're theoretically growing at a much faster rate than so-called value stocks. But therein is the rub, that the sustainability of the growth rate, and what we've seen in the earnings reporting in this quarterly season we're just finishing it, is if the earnings expectations are missed, the growth expectations are missed, the stocks are pretty harshly dealt with.
It's a very punishing market. On to Georgia, where Steve joins us. Hello, Steve. Go ahead.
Steve, you out there, buddy?
See, I'm on. Can you hear me?
Yep.
Yep. Little back.
Okay. My interest is in biotech. I've owned them since '96 and '97. what's your theories of their worth?
Biotechs in general, the sector, I think, is what Steve's asking about.
And of course, if there's anything you like, feel free to share it.
Well, they're starting to perk up. And the reason for it is that that's kind of the high margin segment of the healthcare field today.
Right.
You don't really want the bricks and mortar or the administrative problems, but there's a lot of innovation going on in the biotech area, and my only suggestion there would be it's so hard to select an individual company that, that probably a mutual fund that would cover a diversified group of biotech would make the most sense.
You really have to do your homework on this sector, don't you?
Yeah. I was going to ask if you're interested in the biotech area, like Steve clearly is, but you're not sure where to go. Mutual funds, a good place to start in terms of
Well, it's a good place to start mainly because you get the diversification in it. So you don't have the event risk associated with a single company. And you also want the technical ability, the ability to understand the technology that's going on within that
part of the market.
Right.
That's
Either
excellent.
that or you were a science major and you love to read all that stuff.
Hey, Carl, let's go over to Pennsylvania.
Okay.
Carl's on the line. Go ahead, Carl.
Yes, I bought Qualcomm, unfortunately, last week, $30 higher than where it is now. Should I hold or buy more or sell?
Well, Qualcomm is an absolutely wonderful company, and they have technology and they have patents. Those patents, however, at least the current group will be maturing in about 10 years, so they've got a life, but Qualcomm does have the advantage that it is at the vanguard in coming up with new patents and new technology all the time. They have excellent management. It's the price, and you paid a higher price a week ago than you did today, and again, that's the case for this dollar cost averaging concept, because the fact is that Qualcomm has gone up literally 10, 15 times in the last year, so that the price is very high and the market is trying to adjust to that. The fact is that the Qualcomm management was very candid in saying that the expectations for the future won't be as great as they have been in the last few years. So that said, I think you would hold Qualcomm, but I think you can wait for probably lower prices and expect for that particular investment that you'll probably experience a lot of volatility and perhaps lower prices as well.
I mean, it is a stock, it's worth remembering, that went up last year 2,400% plus. So,
Yes.
I mean, the stock had a lot of run in it last year in over 52 weeks.
I think my favorite call this week was someone who asked if it would go up another 50%.
Yeah.
That was one of my favorite calls of the week.
Well, it's interesting.
And that was a very optimistic person.
Yeah, I know. It was interesting. I spoke with the chairman yesterday, Erwin Jacobs.
Yes.
He was on our air, and we spoke with him. Very cautious first half of the year, very bullish, actually, second half of the year. Remains confident that the company can meet Wall Street's expectations. But, I don't think he or anybody else expects the stock to go through quite again this year what it did last year.
No, of course not. And the real key here is that while they will have earnings growth, it'll be requiring that sustainability of the growth to justify the very high prices, or at least from this point the ability to tack on additional prices that would be competitive with other alternatives.
All right, well, we're going to take a break here. Roger will continue to take your calls afterwards. The
Our number?
Talk with.
We're back.
We have the mystery phone caller on the line because
We're
nobody would tell
taking
me where
calls
we're
about
going.
stocks with our guest, and it's Roger Debard. Give us a call, 1-800-304-FNET. And our next caller is, they're going to tell me, Rick in New Jersey. Go ahead, Rick.
Oh, Roger, I own JDSU for over 2 years now, and with all their acquisitions, I was wondering if we're in the third inning of a 9-inning ball game.
That's been a wonderful stock to own over the last couple of years, so you've benefited. And whether it's in the third inning, I think they are certainly in the third inning in terms of their business and their long-term prospects. In terms of their stock price, it would seem that they're probably closer to their fifth inning rather than the third inning.
Do you like that group in general? I'm curious. The fiber optic communications crowd. Do you like that crowd?
Yeah, I mean, and the reason you have to like it is because it's a better mousetrap. It's a better vehicle for communicating particularly data, and so that it's without question going to be here to stay.
On to Wisconsin. Dennis joins us. Hi, Dennis. Go ahead.
Hi, Roger. I've been purchasing Sara Lee stock for probably the last 10 years and dividend reinvestment, and I was just wondering, what's happening now? I paid $30 for the stock within the last year, and now it's only like 18.58, or
Yeah.
what can you expect from something like? I mean, it's a good company and everything.
Well, there's been pressure on all of the food companies. They've had a hard time increasing prices for the products. That's the fundamental problem. It's on the revenue side, and their costs are very difficult to reduce. You've got companies like Kraft, that's part of Philip Morris, that has done an excellent job at running a very mean and lean shop. I don't know Sara Lee too well as a company, but I just know the economics of the business are such that it's a relatively low margin kind of business. It's not high growth, and more importantly, it's like a lot of stocks that it's a good company and it's a profitable company, and they're providing products that people buy all the time, over and over again. But it doesn't have that pizzazz that a Uniphase or a Qualcomm has, so that from a stock price standpoint, investors are simply not too interested in it. So I would keep my eye on the earnings growth, but I would say I don't have high expectations for high rates of return.
All right. Well, we need to run off and take another really quick break here. We got some folks hanging on the phones. Don't go away.
Sit tight. We'll be right back with Roger Debard.
Meanwhile, let's get ourselves caught up on the markets. The Dow coming off a spectacular rally, dropping into negative territory, coming back up again. It's kind of like riding the rough seas, and Rhonda Schaffler has been watching all of the action. Rhonda, well, it's time to be seasick now, I think.
But those waves are so much fun, aren't they, Bill? At the moment, the Dow is fighting its way back, but what's going on here, and what's been sort of a consistent pattern, is that traders are selling into the rallies, and no exception with that today. There is some strength in certain issues. Some of the financial stocks are moving higher, like American Express. Overall, though, it's pretty mixed, not just in the broader market, but within these individual sectors. And one group of stocks where we're seeing a mixed performance, technology issues. Hewlett-Packard is a Dow stock. It is one of the better performers here, and it is one tech stock that's moving higher. We want to take a look at those technology stocks, and we'll show you where the gains are coming from in HP. Up 2.5. HP actually gave some positive guidance late yesterday in response to the warning by Dell Computer. HP is going to report earnings in mid-February. It says its revenue growth is strong, and earnings growth should be about 12 to 15% for the full year. ST Microelectronics is up about 3.5. Nortel Networks is down 1.5. Late Wednesday, BCE of Canada said it was spinning off a 37% stake in Nortel. SCI Systems is down 4.5. After the close yesterday, it reported fiscal second quarter earnings of 68 cents a share. It was 2 cents better than expected. Did announce a 2-for-1 stock split as well. Today, Soundview said the stock might be falling amid concerns about Dell. And EMC is currently down 7 1/8. That's extending yesterday's loss also of about $7. Wednesday, EMC reported earnings above expectations, but analysts cited a slowdown in revenue. And of course, the stock market also focuses on those forward-looking statements, so signs of a slowdown enough to get investors moving out of that stock. Bill?
Yeah, Rhonda, I was just looking at some of the charts on the market today. The financial stocks remain strong. They're off their highs, but I'm wondering what's behind the strength in the financials.
Yeah, financials, that is one sector that really almost starts to annoy traders because people get into it and then they get out of it very quickly. Little help coming from the bond market today. Interest rates backing down a bit. That's often a knee-jerk move. Then you have people start buying the financial stocks. Fundamentally, it's not that the picture's changed any. A lot of people think the financial stocks have been beaten down a little bit unnecessarily because of interest rate worries.
Maybe by the Fed meeting, they'll straighten out a little.
We hope so.
All right.
You'd think they'd be quiet in front of it. Thanks, Rhonda, for that report.
All right. We are taking phone calls. We're talking to Roger Debard of Hotchkiss & Wiley.
Okay, he's here to take your calls. Give us a ring at 1-800-304-FNET. We've got Bill from Texas hanging on the line. Thanks for being patient, Bill, and go ahead with your question.
Yes, Roger. I wondering what your outlook is on Global Crossing. I perceive that there's a glut or overbuild of undersea fiber. I'd like you to comment on that and what that might do to the pricing.
Well, I don't think there's a glut. You basically have got the run from the United States to Europe, and you have it prospectively to Japan and Asia. And it's a marvelous technology, and it's the technology that is going to allow for an increasing amount of information and data transfer between all kinds of businesses in this country and Europe. And when you see the evolution of the European market coming together, as well as the progress that's being made in Asia, I think there's going to be nothing but increased need for information and data communication. So I would say a global crossing on a long-term basis is going to be excellent. You're just going to have to suffer the indignities of perhaps a very volatile stock price.
Taking a look at that trading chart, you can see exactly what kind of volatility has been going on. On to Ohio, where Dale joins us. Go ahead, Dale.
Hi. I was notified in late last year that John Hancock Mutual Life Insurance Company was going public, and that my 45-year-old policy with them would give me quite a few shares. I'd like to know what's going on.
Well, it just went public today. That's what's going on. And the last that I saw today, the price was up $1. So
yeah, it's up about that now.
It's up about that now. And it's an excellent company, well-managed company. And you know, the only commentary is that most IPOs put on considerably more profits in the first day, but that shouldn't be anything interpreted as negative. It's a good company and a good long-term holding.
Yeah, you look at video of Stephen Brown ringing the opening bell, as a matter of fact, this morning on the New York Stock Exchange. But you know, Roger, you like insurance companies. One of your stock picks is Allstate. Do you like this group? This is another one of those been beaten down in the market groups.
Well, part of the reason we like it is because it's been beaten down. That's part of the idea of finding good value. In the case of Allstate, they're the second largest personal lines, auto, property insurance company in the country. They're an excellent brand name. Their reserves are well positioned. Their rating and their method of doing business is very conservative. So as an insurance company, we think that is a good business to be in. It's a business that we all need. There's competition, but if you can be a low-cost producer in that business, which Allstate is in position to do, it's excellent. So yeah, we very much like the financial services group in general and insurance companies in particular.
And so Dale in Ohio should be happy with his distribution share on John Hancock.
I think so.
Yeah.
And we're happy for him.
Excellent.
On to California. Michelle, you're up.
Yes, I'd like to know about MCI WorldCom and what the merger with Sprint will do for the stock.
We don't own MCI WorldCom, but conceptually the merger effectively will bring together some critical mass. There's no question that in the wireless communication, you've got to have the critical mass, and that will achieve the cost cutting and ultimately the increased margins. So that combination is very viable. It seems as we're looking at that industry that you're getting down to maybe 2, 3, 4, or 5 companies at most that will be dominant in the wireless communications.
All right, Bill from New York, you're on the line. Go ahead. Bill, you there?
I'm North Carolina.
Oh. Well, that's a long ways from here, partner, but go ahead.
I'm glad it's not New York. That's why I was shocked it's cold enough in North Carolina.
I was going to say, you got a lot more snow than we do, Bill.
Yes, we certainly do. My question is that since Delta Airlines purchased ASA and Comair, and they're in great position, I own a lot of their stock. Should I hold it? Should I sell some of it? What is your opinion on that?
Well, the airlines have got two issues really. One is the load factor, and we're probably coming into a seasonal period where the load factors may be a problem for the airlines. So that may be a negative. And secondly, oil prices have gone from that $11 to $13 range a year ago now to 27.5, and they could go higher. But even at this level, it creates some cost pressure on the airlines. So I would say Delta is truly one of the 4 to 5 airlines in this country that has the right route structures, the equipment, the ability to finance new equipment. So it's a good company and it's a good holding. But in terms of near-term prospects, I think the airlines in the last week or so have been under pressure in terms of their stock prices.
We have to take another break, sorry to say, but we'll be right back. We're talking to Roger Debard, and we will take more calls right when we come back. Roger Debard of Hotchkiss & Wiley.
All right, we have Dan from Arizona on the phones. Go ahead, Dan.
Yes, Roger. Is now a good time to sell CBS, or should I hold through the merger with Viacom?
Oh, I think I would hold it. There's so much going on within these media stocks today that, I mean, unless the purpose was to take profits off the table and you have a better place for the money, clearly the whole content business, the media business is one of the most attractive places. There's considerable merger activity going on today, and I would say that's going to continue both for CBS and the other media companies.
Yeah, Bill and I don't know anything about that kind of stuff.
That media stuff?
No, that merger stuff, no. On to Missouri. Terry, you're next. Go ahead.
Yes. I've been buying Walmart stock for over 20 years, and I'd like to know what you think about the short term and the long term of this stock is going to be.
Well, I think the long term is probably the most important. There's virtually no retailer in this country that is as potent, and as you are probably well aware, they are expanding beyond the borders of the United States. So you can just go into a Walmart store and see what kind of volume, number of people they have, and the amount of purchasing that's being done there. And it's just an excellent retailing concept, and it's one that can be replicated by other people, and others are looking at their model, but it's so hard. They have a head start. So I think for both the short term and the long term, it's definitely a long-term hold.
Yeah, Terry's been in that stock for quite a while. It's amazing. I'm looking at a chart, and you know, over an extended period of time, it looks like an internet stock.
Yeah, it does.
Nice gains.
It has that ski slope look.
I mean, I think we all have to compliment Terry for having had that the confidence 20 years ago, because 20 years ago it was around, but it certainly didn't have the prominence that it has today. And perhaps it was local knowledge,
it could be,
or acquaintance, or just going into a store, and the old Peter Lynch method of looking what people are buying and where they're buying it. And that maybe is a good investment thesis, you know.
Okay.
That's terrific.
On to British Columbia. Right. Let's go to Mark. Mark, you're next.
Yeah, hello there. I'm 33 years old and just about to sell a house that we built, and I'm going to have about $200,000 that I'd like to invest for long-term growth in the stock market. Obviously, I'm concerned about the baby boomer age of the population, and in 10 or 15 years' time, where my investment might sit. So I just wondered what kind of weightings you would suggest to realistically, you know, ride out the current market the way it is, and in 10 to 15 years be sitting on a nice return on the investment.
Mm-hmm. This is a large sum of money, and probably an amount that you want to have a combination of growing and at the same time protecting the assets. So it would probably be prudent not to have 100% in the stock market today, only because, at least for some segments of the market, it's in pretty high watermark. That said, as I said before, there's plenty of stocks that are very high quality and that are fairly priced today. So I'd recommend a mutual fund or a combination of mutual funds that you could diversify the investment, probably putting perhaps 50% in the stock market. And I would take advantage of the current level of fixed income investments today, when you have U.S. Treasury notes and bonds in the 6 3/4% range. It's not subject to state income tax, so it's an enhancement, and it's high quality, highly liquid. You can always sell them if there's additional opportunities in the market. And I think that combination of getting an income generation from fixed income, as well as buying value-oriented common stocks, which would be the recommendation today, then that would probably be a good asset allocation and a good split of the equity market and the fixed income market.
Tony in New York, you're up. Go right ahead.
Yes, thank you. I own Janus Global Tech, And I was also interested, I'm interested in the short and long term on that fund, as well as the short and long term on Janus Global Life. And any other comments you care to make on any other Janus funds, I'd be very interested in.
Well, I don't really know what the ingredients of what the individual stock holdings are, and you kind of need to do that. And I would suggest that, you know, it would be a good idea if you looked at the actual holdings, because I suspect that it's a very growth-oriented and perhaps a high price earnings multiple kind of holding. So you'd have to make a decision whether that really fits your long-term needs or even short-term needs in terms of the current valuations. I suspect that those funds, even though you have the diversification, just because of the nature of what they own, are going to be pretty volatile in the next coming months.
And Roger, just to flesh this out a little bit, as you look through, you get your prospectus, you look at what stocks are in the fund. How do you make the decision? What kind of criteria do you apply to these stocks to make a decision on whether you should keep it or not?
Well, it's interesting. That kind of information wouldn't come in the prospectus, but it would come in the annual and the semi-annual reports that are produced, and sometimes quarterly reports. And particularly with the new communicative language in the prospectus as well as these reports, it's likely that there will be investment characteristic information on the holdings. So that while the average person wouldn't be able to tell what kind of earnings and the characteristics of the individual stocks, perhaps the fund company would be communicative. And if not, it's absolutely open to all investors to call the fund company and ask that kind of information, and I would recommend doing that.
Okay. We have to take another quick break.
And Roger, we'll continue with your calls right after this. Stay with us.